Welcome to Reshair Radio. I'm your show host, Chris Reshaar, licensed loan officer with Hometown Lenders. We're back for another Reshair Radio episode. If you have never listened to Reshair Radio before, we are on every Sunday morning on ESPN, The Game, here in Charlotte. And the show really is about empowering, exciting, and getting Charlotteans really financially stable, sound, whatever you want to call it. But we do that by bringing in expert contributors and local specialists that kind of talk about real estate, insurance, investing, financial planning, credit repair, you name it. So super excited about today's show because we've got one of our expert contributors that we're going to be introducing here in just a minute. So let me remind you what I do before we roll out what our theme is for the day. I am a licensed loan officer. I've been on the air for over 4 years, I think, here in Charlotte, somewhere in that range. And most of the time I talk about other people's business, and there's nothing wrong with that. I want to make sure I support my sponsors and support the people that bring me business. But really every day I do mortgages. I help people just like you that don't own a home, or people out there that do own a home that want to buy a second home, that want to invest and buy investment properties, or even those of you that own a home that want to refinance to a better rate, shorter term, whatever. So just know, as your host of Reshair Radio, my first job that pays the bills is being a loan officer and branch manager of Hometown Lenders. And so if you have any questions related to the mortgage process, you got to call me, right? I'm the one sending messages out to you Sunday morning, keeping you awake behind the wheel, whatever it is, on the way to church or on the way home. But I want to make sure you know how to get a hold of me. My number is 704-277-4463. That's 704-277-4463. That's my cell phone. You can call me, text me, just say, I need help with a loan, and I'll jump in. You can also find me on the web. If you're a web person, you can do an online application at themortgagegenius.com. That's 3 words, themortgagegenius.com. And as always, if there's any show that you want to listen to in its entirety, you missed it for some reason, you only got caught part of the show, you can go to Reshair Radio. That's RESH, reshairradio.com. We have our sponsors on there, our guests on there, and every show that we recorded in the last several months that you can go back and listen to and tap into our expert contributors and use them. If you need someone for credit repair, home inspections, whatever it might be, homeowners insurance, please use my sponsors. They spend money every month to support what we try to do, and that's educating our people, our community out there about how to be financially stronger. So without further ado, enough about me. We're going to introduce our guest here, Cole Duran with National Credit Care, expert contributor, and I'd like to say repeat offender, right? Repeat offender. Back into the studio here. Cole, welcome.
I appreciate it. Thanks
Glad to have you here in Charlotte. I know you travel a long way each and every time we have you on the show. Where is your home officially now?
Well, now I moved from the beautiful state of Colorado to the gorgeous state of Michigan. Which,
there you go. I don't know. It's a toss-up.
Colorado has its benefits, but, I wanted to move closer to the business, the folks that I work with, just so I can make a larger impact. And
sure.
In the Michigan, area, the economy out there, there's a ton of folks that are in need of, our program and what we offer. So just wanted to move a little bit closer into that territory and make a larger impact.
Yeah, it just seems like when I talk to you, it's like, where are you coming from today? But we have you all the way from one of those 2 states on a regular basis here in the studio. So tell our listeners, and you've been on the show before, you've been kind to support what we do, and you understand that every chance possible that I get a client that needs help in the credit department, you're my go-to person. So tell us about what you do, what National Credit Care does, break it down into the elements, really give our listeners a good flavor for what you're all about.
Yeah, so National Credit Care, really cool program. I've been with the company now 7 years. I started at the very bottom. I worked my way up through every department, so I really have a grasp at, what, our company is really able to do. And for the, long story short, we clean up a credit report. And the results of cleaning up a credit report are higher credit scores. Higher credit scores lead to lower interest rates on your home loans. Credit is also into car insurance. It's in your auto loans. It's in your personal loans, your student loans.
Yeah, pretty much your credit score affects so much of what people do today.
It does.
And people don't always understand that.
Yeah, I mean, folks don't realize exactly the impact that credit does make, not just on a monthly basis or a yearly basis, but over the big picture. Over the span of the next 20, 30, 40 years,
Right.
all the purchases that you're planning on making. Maybe you're planning on getting a couple houses, as Chris mentioned, or maybe you're wanting to get an RV or a boat, things like that. Credit is going to come into play at some point in time, and it's it benefits those that really take a look at it before you reach that table and say, hey, I'm ready to go. It's the folks that plan and have that preparation and know exactly what their credit score really looks like, the ins and outs, before they hit that table and start asking for things. As in today's economy, we're kind of in that stage of I want it now. I want it now.
Absolutely, and I just have to share this because on a day-to-day basis, when I'm working with potential buyers and we are struggling with credit, I have this conversation, Cole, where I say to them, if I were to boost your score today by 50 or 100 points, would you give me $500 to do it?
Oh,
And
give you
everyone says,
1,000.
well, yeah, right. Yeah, I'll give you $500. Because then sometimes I'll say, well, would you consider, talking with Cole, my friends at National Credit Care, and maybe them helping to improve your credit situation. We can't make guarantees in this world, and I got to be careful about what I say on the air. But I say, if they can help you boost your scores, that 50 to 100 points over the next 6 months, and you had to invest, right? I'm using the word invest for a reason. You had to invest $500. Would you do that? Now, it's not any different other than you said, I want it now versus I want it over 6 months. And people think about it like, gosh, you're right. I give you the money now if I got the scores now, but how come I'm not okay with it if it takes 3 or 6 months? It doesn't make any sense because the result is the same, right? And that is we're improving your score to get you into a house. So both strategies, the strategy of giving you the extra points now doesn't even work, right? You have to put the effort in.
Right.
So anyway, sorry, you said we are a society that wants it now, and I just had to share that because I have this conversation with buyers all the time.
Yeah, so with credit, making such a large impact in not just the home loan, but, every type of, account that I listed there, the credit cards, the personal loans, the auto loans, the car insurance, you really want to start focusing on this credit score sooner rather than later. You don't want to wake up and you're 60 years old and then all of a sudden it's like, hey, well, I don't have that much time to do the things that I want now because I didn't pay attention to this credit score at first. So the sooner we can, overall just take a glance at your credit report, what we're going to do is formulate a game plan based on your report, not based on Susie's report, Joe's report, based on your
It's all about you.
It's all about you. It's a personal game plan based on your finances, your current living situation, current credit score, the accounts that are on there, the balance to limit ratios on the credit cards now. My team will formulate a game plan on how to get from A to B. And the quickest way to do that and the most financially sound way to do that. We clean up credit reports, and really what that means is we've located a flaw in the industry. And the flaw is creditors and collection agencies and public records offices at the end of the day do make mistakes. They are human. Okay,
Sure.
There's humans working at those companies, and there's human error that comes into play. And what we've noticed is a lot of this material, a lot of debts on credit reports nowadays happen to be impartial, which means creditors and collection agencies aren't holding up their end of the bargain. Okay, the Fair Credit Reporting Act states every account, if it's on a credit report, has to be 100% accurate, verifiable documentation. And what we've noticed over the past few years is, it's somewhere in between 60 and 80% of these debts on credit reports are impartial. So there is
Or
room.
they're not 100% accurate.
Exactly, or not 100% accurate. So there's room to grow there. And my team, we specialize in knowing exactly what information to ask for when, questioning and challenging these items at the bureau level. They hold the torch. Okay, Experian, TransUnion, Equifax, they hold the torch at what's on the report, what comes off. I know a lot of clients try to do this on their own. There's online disputes, things like that you can do. But at the end of the day, there's nobody more powerful than the bureaus when trying to work on your credit because they, again, hold the torch at what's
They
on that
hold the
report,
power.
what
Absolutely.
comes off.
Absolutely. I have to say that, I've had a situation where recently where actually there was a mistake on the credit report in the opposite, and that is a customer actually had a foreclosure and it didn't show up on the credit report, where I normally rely on that as a tool to determine what program, when they can buy, have they done the wait times. And unfortunately, we had to deny a loan recently because it showed up on an external report that our company did behind the scenes. So you're right. I mean, it was to the point where the credit report wasn't accurate, that they didn't even have a foreclosure reported. Now, it could have been looked at as a good thing, but it turned out to be bad news for the client because it was just wrong information on the credit report.
Right.
So
Happens all the time.
yeah, exactly. So, well, I know we've got a couple of minutes before we take our first break. First of all, just tell me a little bit about what you like about doing your business before we take our first break.
Helping people. And not just helping people, but really, truly helping the people that need it most. It's extremely satisfying, helping somebody that just felt like they were in a hole that they couldn't, be dug out of. At the end of the day, there really isn't a hole that you can't be dug out of. You just need to have the attitude and motivation to start now. And my team will give you the tools to start repairing, improving credit scores so you can better your financial situation.
Yeah, and if you don't start, right, if you don't change your behavior, you can't expect a different result, right? Pretty simple adage. But you're right. And helping people is why I do this show, why I am a loan officer, because I really enjoy helping the first-time buyer, helping the person that I get a call from that said, well, I talked to 2 or 3 other companies, but they just couldn't figure out a way to get my loan done. And somebody said, call you. And that's like the best call, right? And I can't always fix everybody's problems. I can't make their income, increase on their tax returns. I can't solve every problem, but it's that kind of challenge gets me excited about doing this business. So, Cole, real quick before we take a break, tell people, if you give us your phone number twice and the website or an email address, whatever you think, because this is a show, folks. If you're driving around listening to us or you're at home and your credit is not perfect, this show is all about you. And I want you to know how to get a hold of Cole or myself. But go ahead and share your information real quick.
Absolutely. And when Chris says perfect credit score is 850. So,
Right.
If you're not,
I've never seen one. Seen one.
If you're south of 720, south of 750, there's room for improvement. Please contact me with any type of questions, concerns. Hey, you're just wanting to chat. It's not going to cost you anything. My phone number is 313-338-4717. One more time, 313-338-4717, or you feel free to email me at my first name, Cole, C-O-L-E, @nationalcreditcare.com.
Boom. Easy. Call Cole. Stay tuned. We'll be right back.
We're with Chris Reshair, Senior Loan Officer with Hometown Lenders. Chris, first-time home buyers. I hear this might be the perfect time for them to take that step.
Absolutely, Chris, man. There are so many amazing programs out there, from state programs to local programs here in the Charlotte area. And let me tell you why they're amazing. Many of these programs, and I have to tell you, I'm a first-time buyer specialist. I love first-time buyers, but some of these state and local programs offer anywhere from $7,500 to $17,000 in down payment assistance.
Chris, the key too is whoever you're working with when you're ready to take that step, you want to make sure that your senior loan officer is knowledgeable about all of these programs.
Absolutely. A lot of loan officers know about these programs, but this is what I specialize in. Don't let the hurdle of you not having a down payment not let you own your first home. That is what we're going to do. We're going to help you figure out what those hurdles are, save you from that down payment hurdle, and get you into a house. That's what it's all about, Chris.
Chris, how do people find out more information?
Yes, so for more information, you can find me on the web at themortgagegenius.com. That's 3 words, themortgagegenius.com. And as always, you can call me or text me at 704-277-4463. That's 704-277-4463. Again, it's Chris Reshaar with Hometown Lenders, NMLS license number 117266, Equal Housing Lender. Welcome back to Reshair Radio. I'm your show host, Chris Reshaar, licensed loan officer with Hometown Lenders. So if you have not been listening to the first segment, you're just tuning in right now. Today's show is all about managing your credit. We've got Cole here in the studio from National Credit Care. And Cole is one of our expert contributors. He's been on the show many, many times before, and a consistent sponsor of Reshair Radio. We appreciate his patronage. But we really wanted to bring a show, like a 1-hour show with you, Cole, here to our listeners so that we could really deep dive into managing credit. So you talked a little bit about the company, the things that you do there for people, and we kind of weaved a little bit in the first segment. But we really want to talk about managing credit. So if let's just say we've got somebody that's listening out there that's 17, 18, 19 years old, knows that he or she wants to kind of build credit in the future, where does somebody start? What do they do in terms of starting off on the right foot to build credit?
Right. So really, you based on the accounts that you have open, when you're 17, 18, 19, most of those folks don't really have any credit because they don't
Right.
have any open credit cards. There's
How do you
nothing-
get credit if you don't have it?
Exactly. So I'm asked that question, on a monthly basis. How do I get a credit score? Well, you want to take a look at the pie chart. Where credit score is generated. What's what are the the larger categories, and the largest categories are payment history and credit utilization. Which credit utilization is actually just credit cards. So if you don't have any credit cards, you can see quickly on how you're missing out on available points.
Sure.
And payment history is credit cards and loans. And the kicker with loans, eventually you're going to pay the dang thing off. And unfortunately, when you do, all those years
That
of
history
history
kinda-
it goes away.
Right.
Which kind of leads me to why credit cards are so important. And so, ideal for long-term
But
consistent
wait, my
scores.
dad said credit cards are the devil.
We've all heard that. And
Right.
if you misuse them,
My
they
mom
can be.
said.
Right? If you misuse credit cards, they can be. But they are the number one tool to building a more rapid score. As you're gaining a few sets of points via a credit card a month, loans really just one for making the payment on time. Credit cards are factored into a few different categories. So you could build a more rapid credit score, more of a rapid increase.
I
utilizing your
totally
credit
agree
card.
with you. Yeah.
And again, long term, okay, consistency. We've all kind of seen, the age range between 20 and 30, 30 and 40. Those folks that have seen their credit scores, when they went and bought a house or a car, they see it fluctuate quite a bit. And there's a lot of reasons why credit scores can fluctuate. But if you're wanting to sort of eliminate some of that fluctuation over the years, it's your credit card that's going to be the spine of your credit score, and it's going to hold you strong long term, as you don't have to close a credit card every 12 months worth of payments. You're just stacking another year's worth of payment history to your credit score.
That's right.
And you're constantly building.
It's adding strength
It's
over
adding
time
strength,
and
absolutely.
depth. But let's just say, I don't have any credit at all. What would maybe be a starting point to get an account open?
Well, applying for a credit card now, there's two types of credit cards that you could apply for. Now, you can apply for a normal credit card, which is also known as unsecured, or
Okay.
you can apply for a secured credit card.
See, I've had people say it, but I tried and I just got rejected
And that will happen from
because
time
I
to
don't
time.
have score. How do you expect me to get a score if I don't have a chance to open an account?
Right. So the secured credit card will knock that out for you.
Okay.
Yeah, secured credit cards you cannot be denied for if it's a true secured card. Now keep in mind there are some banks out there that will advertise they offer secured cards based on your credit worthiness. They'll depict your down payment. That's how you know right off the bat it is not a secured card. If they pull credit to see if you're approved, it is not a secured card. A secured
Okay.
card, you
Interesting.
offer a down payment.
That's something I didn't know.
Yeah, if you offer a down payment with this, the secured card, all that's required is a down payment. Okay, they're not pulling credit. You give them the down payment, they issue your credit card, and it's a normal credit card. You have.
So you're putting money up front on a secured card.
Yep, and you do. At the end of the day, if you do close the card, for the most part, you typically get your down payments back. But you don't want to think that it's let's say it was a $200 down payment. A lot of the times it is. You don't want to think of it, hey, this is a $200 investment to open up a credit card. No, this is a $200 investment to obtain a home loan,
That's right. To buy a house,
to buy
and
a
car,
house, buy a car, buy the RV,
the rest
or the
of your
boat.
credit.
Exactly.
Yeah, makes sense. All right, so for that first time, person that wants to build credit, you may have to start with what we call a secured credit card, and I know that they can be found online. I know that sometimes you can go to your local credit union or bank. Sometimes they have them when you go in, so that may be the first place to start. And as Cole said, sometimes there's even secured installment loans. But that credit card is key to, I think, building your credit more rapidly.
It's revolving.
Yeah, revolving. So you pay it down each month, you use it again, you pay it down, and you're showing them month over month that you're managing not just paying them, but the account going up and down. Whereas an installment loan is a fixed payment every month, and you're paying that every month, but you're not showing any sort of management of debt. You're just showing that you're paying the same debt every month. So definitely I've seen people where, and it shocks me, they come to me, they try to get a mortgage loan, and their scores just say in the mid 600s. And I look on the credit report and I see student loan, car loan, student loan, student loan, student loan, car loan paid off. And that's it.
Right.
And they're like, my credit's been stuck in the 600s for the last 5 years. I don't know what to do. And I say, well, you don't have a revolving credit card. Well, no, I don't want one of those, right?
Money under the mattress,
Well,
right? We've all heard it.
So I say, look, you open 1 or 2 credit cards and call me in 3 or 6 months. And my guess is if you pay on time, your score is going to be above or 700.
100%.
And I've had people come back, go, it worked, right? It's like, well, yeah, because that's part of the formula, right? Credit is your credit score or future credit score is made up of 3 categories. One is
5 actually.
Well, okay, so maybe step me up, but I'm thinking you've got the revolving accounts, installment accounts, and then potentially mortgage. But if there's more that I'm missing, please speak up.
Yeah, so five really categories to pay attention to. Largest one being payment history, which is 35%. 30%, next largest, is credit utilization. Important thing to know with credit
Right, and I was speaking
utilization.
about the credit mix of credit, which is 10%.
Oh, yes, absolutely. Yeah, really just 2 types of.
You've got revolving, installment, and then mortgage. But go ahead.
So going back to the categories, you have your 30% utilization, 15% is average length of payment history, 10% is the types of credit accounts that you have.
Correct.
And one, there's really 4 perfect types at the end of the day. One a credit card, and one an auto loan, one a mortgage, and one a personal loan. So that credit card is not just helping in that utilization category, not just in payment history, but that types of credit accounts
Right,
as well.
you've got a mix.
Mm-hmm. And last is 10% of which is new credit. And at the end of the day, new credit, translating that, is inquiries. When someone is pulling your credit report, which you do want to stay away from, but when you go apply for a mortgage, you apply for an auto loan, you apply for a credit card, sometimes that's unavoidable. And one person,
It's part of the process.
exactly, it's part of the process. And one person pulling, please know, it's not the end of the world.
Thank you.
Folks like to think that inquiries, someone's going to pull my credit, my score is going to drop off the map. If one person is pulling your report, even if they pulled all 3 bureaus, it's maybe anywhere from 2 to 8 points. It's not something extreme. The only
Right.
time you want to kind of be wary is in the auto industry. A lot of auto lenders like to shotgun credit out. So that's really the industry you kind of want to be a little bit weary of when someone's applying for an auto loan. You're like, hey, maybe just have a couple of lenders pull this report, and it's instead of 10 to 15.
Yeah, honestly, the surprising part is the person that doesn't want the inquiry in their credit is usually the person that has the highest credit score there is. I'm like, it could drop 100 points and you're still going to buy a house, right? But they obviously have learned strategies to protect their credit. So, okay, so we talked a little bit about sort of the person that wants to build a credit history, doesn't have a lot of credit, how we kind of gain access into building credit. But eventually, once you have maybe a secured revolving account, maybe a secured installment account, from that point, as long as you pay it on time, and typically it starts with about a 6-month history, you might get offers in the mail, or you might be able to go to apply places, and you might have a score pop, right?
Exactly.
You may have a score show up.
Mm-hmm.
But I will tell you, you mentioned that 10% of people's credit is new credit. Well, when you have new credit, if you have negative activity on that new credit, it just completely blows your score down into the bottom of the ocean.
Yeah,
right?
there's
It's like you had your chance at a first impression and you screwed it up, right? We just got new credit and now you can't pay a $10 minimum payment on time. Folks, if you get credit, just pay it on time. Pay your utility bill late. Pay
there's
something else late.
There's negative contracts and positive contracts. So folks that are working with us that are paycheck to paycheck, struggling. Hey, maybe a medical bill popped up this month and now all of a sudden can't make payments on all the bills. Well, there's positive and negative contracts, and what that means is there's some accounts that report on a monthly basis. There's some accounts that don't. The phone bill, you don't see a 30,
Right.
60, 90 day late with Verizon. The only time you see a Verizon account on a credit report is as soon as it's charged off. So
Right.
it's gone past
Went into
4
collection.
months, exactly, 4 months unpaid, and that's when it hit the credit report. But you have a little grace period there. Like I said, you're not going to see a 30, 60 day late payment on a Verizon account,
Correct.
the phone bill. So, there's accounts not to pay should you be in that difficult position where, you just can't come up with those finances for the month.
Yeah, and I find that too. Sometimes it's not that people can't pay on time, and it's not that they don't want to, but life gets in the way. And I said, look, put your paycheck into your bank account and let your $10 minimum payment on your Lowe's credit card or whatever it is, let it draft out. Like you've got the money, right? Half the time you have the money, but you got busy, right? You let life get in the way, and maybe you're not good at sitting down and managing your money on a regular basis. Sometimes those things are very easily avoided if you just put your
Mistakes
payments on drafts. And again, drafts aren't perfect either. You guys still have the money in there. But that's one way in terms of how to manage it a little bit better. So okay, we talked about somebody who doesn't have a lot of credit. We talked about a little bit about how to build it, right? Mm-hmm. Some of the things to build. But let's talk a little bit about what if, Cole, I do have credit and maybe I haven't managed my credit well. So that might be where we have some conversation about what National Credit Care can do. So
certainly. So
let's just say I have crappy credit.
Right, you're 30 years old. Let's say you have poor scores. Poor scores. There's a lot of poor scores out there, but let's call you a 450, Chris. Let's say you're about a 450 credit score, and so there's certainly room for improvement. But what exactly do you do? Right. That's where National Credit Care comes into play. Our consultations are free. Contact myself or my team, and we're going to formulate a game plan, like I said, based on your credit report, not Susie's or Joe's credit report, and what's worked in the past.
And credit advice for someone with a score this low may be different than someone who has a good credit and wants to maintain it.
Exactly. So, if you think about it, the wealthy folks in our nation, who do they see? Who do they ask? Who do they, have behind them as resources? They have financial advisors. They have a team of folks that are helping them make the most financially sound decisions moving forward. Why can't everybody in the United States have that? Well, you can.
Right.
You can. That's what my team
have the right
offer.
team.
Exactly. That's what National Credit Care will offer for you guys, is to formulate a game plan based on your credit report. We're going to take a look and see what type of blemishes are on the report, what can be cleaned up.
What can we open new to boost the credit score up and show new strength?
Exactly. It's not just, hey, we're going to take over these accounts that are holding you back. We're going to walk you through your positive credit. We're going to look at your revolving accounts, your installments, the loans. We're going to look at balance to limit ratios, when they were opened. We're going to figure out how much history you have kicking in and generating on your score, and we're going to formulate the most financially sound game plan to get you from A to B, that 450 up to that 640, 660, 680, 700 plus range. How do you do that? Well, there's steps to take, and it's all based on your financial
situation.
Yeah,
right.
Your financial situation currently, your opportunities. Sometimes family members can kind of help out in some situations. Some of our clients don't have those family members that can help out. So we really want to take a look at your credit report, formulate a game plan that works for you, and that's how we start. That's
Perfect.
how we start improving.
Where can they reach you?
They can reach me. My cell phone is 313-338-4717, or you can contact me via email, Cole, C-O-L-E, at nationalcreditcare.com.
Perfect, Cole. Thank you for that. We're going to take another quick break. We got 2 more segments to go. We're here again with Cole Duran, National Credit Care. Stay tuned. We'll be right back.
Did you know it has been reported that an estimated 80% of Americans have credit inaccuracies on their credit reports? Most people that have either inaccuracies or existing items that can be negotiated or adjusted do not know what their best score could be until they have found a new home, or buying a new car, or applying for a credit card. Then it's too late, and they have to accept a higher interest rate or lose the opportunity altogether. The time to work on improving your credit score is before you need it. Whether you have a 440, 640, or even a 740 FICO score, there is always room for improvement. The National Credit Care team is comprised of individuals dedicated to helping the millions of consumers plagued by credit inaccuracies, errors, and fraud. It is our mission to help inform consumers and alleviate the stress of working with creditors and credit bureaus. Together, we can maximize your scores to get the best interest rates possible and save you money. Call now, 303-747-6390. That's 303-747-6390. Or visit us at www.nationalcreditcare.com.
Welcome back to Reshair Radio. I'm your show host, Chris Reshatar, licensed loan officer with Hometown Lenders, and I'm in the studio here with Cole Duran on this beautiful Sunday morning. And as we overlook the city of Charlotte.
Beautiful.
Yes, awesome, huh? And we really are talking about how to manage your credit today. This is really what the show is all about. Cole's been on the show many times before, but we decided to dedicate a whole hour to managing your credit. We've been talking about how to build credit, what happens if you have poor credit, all kinds of things. But we want to kind of go into now, Cole, some misconceptions that you see a lot that people have when it comes to their credit report. And I definitely have a few that I see, but I'm curious to see what you have to say. So what's one misconception you can think of that people have related to their credit?
Well, one right off the bat is the fact that most folks, when you think credit score, they think it's a concrete score. It's something that's, it stays that way. It stays at that number. Credit scores are changing on a monthly basis.
Right. The target, it goes up and down every month.
Exactly. And, just the balance on the credit card, shoot, maybe I have a 500 limit and I carried a 490 balance on it for the month, but immediately next month I paid it down and now I'm reporting, a $5 balance. Just that little bit, 30% of your score is based on that credit utilization. So, that could be a difference between 10 and 40 points, maybe even a little bit more, just based on where the balance was on your credit card for the month. Not even involving the rest of the items on your credit report, just with the credit cards alone can cause fluctuation. And that's what kind of frustrates clients, is the fact that they don't know exactly what their score is.
Sure.
And so if you just know that credit scores do change on a monthly basis, and as long as your I's are dotted and your T's are crossed, that score won't change too much. But if you kind of don't know exactly what credit does, how to work it, it's a game at the end of the day, to be honest with you. It's just a game, and you really just need to know how to play it. And if you're wanting to learn how to play it,
that's what we're all about.
Contact my team. We're going to give you the tools. We're going to show you how to play the game to better your financial well-being.
So I got a question kind of tied to this. I heard this, and I don't know if it's true, and I didn't prep you for this, so forgive me. But someone told me once that if you pay, let's just say, a credit card bill 5 days before it's due, then it's likely that by the time they run that payment for you in terms of what you owe, they're going to show that you owe zero. And then that's also what they end up reporting to the credit reporting agency. So you might use your card over the course of 3 weeks, but if you pay it early, let's say 5 days before it's really due, then they potentially get a zero balance, which then it can keep your score stronger. Is that concept potentially true?
Great question, Chris. I get this a lot. At the end of the day, your payment date is different from the date of reporting,
right,
for the bank. So what you really want to do is contact whoever your credit providers are, those banks, give them a call and ask what day of the month that they report to the bureaus. Okay, a lot of the times, more often than not, it's not actually going to be on your payment date. But as long as you have that balance, okay, at your balance corrected by the date that they report to the bureaus, that's how you're going to make.
So it might not even be 5 days; it could be 3 days.
Exactly.
So you got to check with the
Your
original
creditor.
creditor that's reporting it. All right,
Exactly.
cool. All right, let's go with another misconception. Maybe you've got one you mentioned about credit cards.
Well, with credit cards, it's just how to utilize a credit card. A lot of folks think that, as long as I'm making my payment on time, I'm doing everything I can with this credit card to boost my credit scores. And it's
So
not,
simply paying on time doesn't necessarily mean it's going to generate the most points. So
It
what
doesn't.
do you mean by that?
So, you're going to get your set of points from making a payment on time first and foremost, and all that's required to get that set of points is a minimum payment. But the second set of points is from credit utilization, okay, that 30% category I mentioned. And it's all about how much you're using of your credit score, of your credit card.
Available limit.
Exactly. So what we preach at National Credit Care is really focusing, and these are for the folks that are really wanting to improve their scores rapidly. Okay, we're going to preach that you just focus on using up to 10% of your limit, but no more. Now you are positive up to 30, but we really preach use up to 10%, make your payments on time.
Keep it 10% or under. So what that means for our listeners, if you're just kind of catching the drift here, if you have a credit card with a balance of $1,000, then you don't want to charge anything more, right, than $100 on that card at any given time.
Exactly.
Keep the utilization at 10% below the available limit.
Exactly. If you are wanting to improve credit scores, yes, emergencies, things like that, credit cards can be helpful. But if you are focused on improving credit scores, how are you going to get the most bang for your buck out of your credit card? Just use under 10% of your limit. That's how.
Cool. Awesome. Well, let's go to the one misconception I like to talk about a lot, and that is paying medical collections.
Or any collection. But
Okay, yeah, well, yeah, whatever. But let's go with paying collections, but medical is the one that a lot of people have questions about.
Yeah. So paying a collection, why more times than not it will actually hurt you and drop your credit score. The fact of the matter is, with a credit report, collections can stay on your report for 7 years from the day that it's satisfied. So if this is something that's been on there for, a year, 2 years, 3 years, and you decide to pay it, what's going to happen is they're going to update that balance with a smile. And they're also going to,
That's right.
with a smile, and they're going to update that data last activity attached to the collection, which makes the collection look new instead of old, and scores will drop. So paying collections is not always the best idea when you're trying to improve credit scores. My team will walk you
And
through.
or apply for a mortgage loan. I'm just saying, folks, don't pay a medical collection before you go and buy a home. I tell people, get into the house. Let's keep your scores up. From a moral perspective, you can pay it once you get in.
Yeah, and for these folks that are listening and are kind of wondering, how do they do this? I mentioned earlier in the program that we use the Fair Credit Reporting Act as a template, which states everything has to be 100% accurate, verifiable documentation. When you sit down and actually think of it, you think of we have the mortgage industry, you have the banking industry, you have the student loan industry, you have the medical industry, you have all these different industries, purchasing and selling debts.
It's a lot of industries.
Exactly. But there's not a large enough overseeing agency. There's not one particular agency that watches every sale.
Right.
Okay. So with nobody watching these folks, there are mistakes being made. And so to really see what opportunities you have, that consultation from my team is going to be really beneficial for you. We're going to point out the areas of improvement. We're going to show you the accounts that we can help resolve based on that information. So
Sure.
it's really helpful.
That's awesome. So are there any other misconceptions before we kind of roll into how to have your credit ready to help you buy a home? Because that's what I kind of want to talk about next.
Well, we've kind of gone over,
we've covered the
common
bases.
misconceptions. Yeah, there might be a couple other ones, but don't, exactly cater to, our entire audience. Those are kind of a file by file basis. But yeah, we kind of covered the most of the common misconceptions.
All right, cool. Well, I'm going to step in and talk a little bit about, for our listeners that do want to buy a home in the future, kind of what is ideal for mortgage lending. So we'll start with ideal, which is a higher standard. First of all, most mortgage companies want you to have 3 open and active credit accounts. Doesn't matter necessarily the types specifically, but 3 open and active credit accounts with a history of 12 months or more. So that's kind of basic standard. So if you don't have much on your credit report, then you might be somebody that you might have limited credit or thin credit. And when we put you into our decision engine, you may not get favorable results because you just don't have enough credit yet. So they're looking for a 1-year history on 3 different accounts. Now, from a credit score perspective, and you would agree with me, having a mix, meaning maybe 2 revolving and 1 installment account, is going to give you the more favorable scores. So 3 accounts open and active for 12 months. The other thing that the lender is going to look for, obviously, is your payment behavior, which is, are you paying on time? That obviously affects your credit score, sure, dramatically, but your most recent behavior in anything is the best prediction for future behavior, right? Your most recent behavior is the best predictor for future behavior. So if you're paying late on your car loans or your credit card now, you're probably going to pay late on your mortgage. That's the thinking that lenders have. Underwriters that work for the lender that make these decisions, they're designed to be put into place to protect the institution because they don't want to do a loan that defaults. Nobody wants a house to go in foreclosure. It's not good for anybody.
And Chris is bringing up a really good point. Actually, one other misconception you just brought up is the fact that folks think collections are worse than a late payment, but as you mentioned, it's all about recent. Okay?
Right.
The most damaging item to anyone's credit report is the newest derogatory information.
Because it shows does your boat have holes in it right now, or did you plug those up 3 years ago? And we see there's there's no industry standard, but I've seen people that will take a nice clean credit history and have one late payment on a credit card and their scores drop 50 points, sometimes more. And that's how much that credit behavior or your payment history can really affect not just your credit scores, but it can affect your ability to get a loan, because then my system's going to take your credit profile, we're going to put it in the engine, and if you have recent late payments, the decision may come back as a no thank you, we can't do this loan, an unfavorable decision instead of a thumbs up. So, all right, so in terms of being credit ready for home buying, we talked about 3 open and active accounts. We talked about paying your stuff on time. That's important. And in general, this doesn't go for every mortgage company, but 580 is typically the minimum score that most local mortgage companies and some banks use to secure an FHA loan. An FHA loan is a loan designed for entry-level buyers, requires 3.5% down. But that 580 is kind of a minimum standard. Just because you have a 580 doesn't mean you're going to qualify, right? There's still a lot of other factors that go into securing a mortgage loan. But we're trying to give you general ideas on how to be credit worthy. So I always tell people 580 is the minimum, 620 is a little bit more ideal. The system gives a more favorable decision when they have a 620 credit score. And in many cases, a lot of the first-time buyer programs, down payment assistance through North Carolina Housing or House Charlotte or some other local authorities, they typically would like to see stronger scores. The state programs, for example, require 640 credit score. So you're listening for the first time, you want to buy a house, we're helping you talk about how to manage your credit today. Ideal 640 is about the really where you want your scores to be out to be ready to buy a home. Can you buy a home with a lower score? Sure. You can get as low as 580, but be prepared to have the down payment of your own money. Be prepared to buy a home that you can afford. You're not pushing the qualifying ratios. It's just harder to get done when those scores are low. So we are out of time again for this segment. We've got one more segment, folks. Again, we're here with Cole Duran with National Credit Care in the studio here on Reshair Radio. Stay tuned. We'll be right back.
Hi, this is Preston Salen with Home Inspection Carolina. We do home inspections, termite inspections, radon testing, any of your inspection needs. One thing that we do a little different, we fix the small stuff instead of putting it on the report. So if you need a home inspection, termite inspection, radon testing, please give us a call. If it's a home inspection or a pre-inspection, 704-542-6575, or check out our website at homeinspectioncarolina.com.
Welcome back to Reshair Radio. I'm your show host, Chris Reshair, licensed loan officer with Hometown Lenders. As always, you can find me at themortgagegenius.com. That's 3 words, themortgagegenius.com. And if you've heard anything on the show or have any interest in calling me after the show, my number is 704-277-4463. That's 704-277-4463. So we're back in the studio here with Cole Duran with National Credit Care. We've been talking everything about managing credit today, from how to get credit established, what if you have some mess ups on your credit, how to have your credit kind of home mortgage worthy. We've got a few more topics, Cole, that we want to talk about before we send you back home.
Yeah, and one I was curious to ask you about, actually, Chris, and kind of get your perspective on in the mortgage industry with student loans.
Yeah, student loans, it's a hot topic, right? Not only on the campaign trail, but it's a hot topic when it comes to trying to qualify for house, because at the end of the day, what we see is we all know that there's been rising costs of tuition and college costs. So it's not uncommon for students to graduate with $50,000, $100,000, $150,000 worth of debt. And they have payments that become due typically within 6 months of that graduation date. But these people want to buy a house, right? Because rent's not getting any cheaper. Right? In fact, sometimes rent is higher than buying a house, right? I see it all the time where we put people into a house cheaper than what they were spending for an apartment, and they've got 3 bedrooms and 2 baths instead of 4 shared walls with a dog barking upstairs and who knows what's going on behind the other wall. But stuff that you don't need to hear. Nonetheless, student loans, going back to the question at heart that you asked about, is that mortgage lending guidelines have recognized that in many cases, we don't want a student loan to prohibit from somebody, somebody that's now working in the workforce to potentially purchase a home. At the same time, you still have to pay the piper, right? So if you've borrowed $50,000, somewhere along the way, you're going to have to pay that money back. And assuming that a zero deferred student loan payment for the next 30 years is just not fair to the mortgage company that says, hey, we know you're going to have a student loan payment on this debt at some point. We can't assume it's going to be zero forever, okay? However, then they came out with this thing called an income-based repayment plan. And allow me to explain what that is. For those of you that don't have student loans or have grandchildren that do, you can have someone graduate from college, have that $50,000 student loan, but the government is going to look at their pay stub or their W-2 or their job offer letter, something that verifies how much that student that just graduated is going to be making or is making. And they determine that, hey, this now workforce member can afford to pay this percentage back of their income towards the student loan debt. Surprisingly, sometimes I see people with an income-based repayment plan on a $50,000 loan in my example with an $11 payment, right? I'm like, $11? Like, you know what I mean? Like, how can you have an $11 payment on a $50,000 debt? Like, sign me up, right? However, as that person's income grows in their career, that $11 will get bigger, right? Again, you're going to have to pay the piper at some point. So what's happened, Colin, this is a long answer to a really quick question, is it depends, right? The answer is always it depends. The individual credit profile and the loan program that they qualify for or are trying to apply for dictates the payment that we have to use or can use to help them qualify. So in some cases, like with an FHA loan, we have to use, if there's no balance reported or they're on an income-based repayment plan, we have to use a minimum of 1% of the total balance. So their income-based payment plan, could be $11 like I just said, but if it's a $50,000 loan, I have to use a $500 monthly payment against them, even though they're only paying $11. So that's huge, right? Now, that makes a big difference as to whether or not that buyer can afford the house, because I have to use a much larger payment than maybe what's being reported. And in some cases, what we do, there's an alternative to that on an FHA loan, where we can go talk to the student loan creditor and say, can you put them on an amortized payment over the course of maybe 25 or 30 years? And what would that payment be? Meaning that whatever the payment would be to actually pay the loan back so that it wasn't forgiven, wasn't shrunk down because your income is low right now, that it actually pays off in full. And they might come back and say, well, on an amortized payment plan, this $50,000 debt would be $232. So we get the buyer to secure that letter with their creditor, their student loan creditor, and say, well, what would the amortized payment be? And then we will use that in lieu of the $500 or 1% balance. So they might still be paying $11. We use $232 or whatever I said to qualify, not $11, not $500, maybe the $200 and change. So it's better, right? Still not great. It's not $11, but we do have to lend responsibly. And that's the thing, I've lived through, the great times in the mortgage business and the downturn. And, let me tell you, in 2007 or 10, let's say 2010, 11, what these years where the economy was down, we had people screaming and yelling, why did this mortgage company lend me this money? They should have never done this to me, right? And they point fingers at the mortgage company saying it was your fault. You did this to me, right? At the same time, when they go to apply for a loan today, and I use a responsible number so that we don't get the finger pointed, right? And it's not necessarily me, but the just general consensus, people get frustrated with that too, right? Why aren't you using $11? Well, $11 isn't realistic, right? Mm-hmm. So now for someone that has a stronger credit profile, what we call a conventional loan, they qualify for that kind of loan. There's two main organizations that we fund loans through. One of them is Fannie Mae, one of them is Freddie Mac. Freddie Mac will allow us to use either a student loan that doesn't have a payment or it's on an income-based repayment plan. Sometimes we can use the income-based repayment, or sometimes we can use 0.5% instead of 1% of the balance. So we will bounce between programs, as we should, as a mortgage professional understands. Hey, we've got a customer who wants to buy a home. Here's their credit profile. Here's how much down payment they need. Here's the kind of home they want to qualify for. Here's their income. And we're going to analyze all of that and try to find the loan program and product that aligns best for that client. So we may hop between, well, we thought we were going to go FHA, but we're going to go with a conventional loan because they qualify, and the student loan qualifying payment is easier to get them the house that they want. So it's a really great question. It depends. USDA guidelines are different from FHA, they're different from conventional. So and it can vary quite a bit, but it doesn't need to stop somebody from buying a home. In many cases, even if you think you're out there and you want to buy a home and you have student loans that's going to stop you, you need to call and ask. I'm going to give you my number real quick. It's 704-277-4463. That's 704-277-4463. It can be found on the web at themortgagegenius.com. You can do a quick app there, themortgagegenius.com. And as always, you can listen to our show anytime at reshairradio.com. So,
and just to actually piggyback really quickly on the student loans, just in case any of our listeners may have, a situation where their, student loans have gone to default or gone to collections. There are ways to get those taken out. At the end of the day, a student rehabilitation program is something that will benefit, these listeners. You pretty much set up a nine payment process, and after the 9th payment is made on time, they actually take all of those student loans out of default, out of collections, and place them back into good standing. And,
that's cool.
Yeah, and with this, you can apply for an income-based repayment plan, as you mentioned. So
yeah, so there's resources. I think, honestly, in today's day and world, unlike where we came from 10, 15 years ago, where you had a pulse, you could get a house, and then we had a crash, right? There's a lot of flexibility in what's going on in these industries, and people are trying to be smarter and more, I think, more fair, if you will, to help people in these situations. Because it's not easy to live in today's world. We still have a lot of wage earners that aren't making the kind of money that they want to, but they have these big debts. They want to own a home because it's not getting any cheaper to rent. So, all right, well, we've got, really just about 2-3 minutes left here. One thing that I wanted to mention real quick for our listeners, and you can jump in if you have any thoughts. A lot of times I will see people try to boost or elevate their score, Cole, by adding an authorized user, meaning putting their name on mom's JCPenney card from 42 years ago that has a bazillion months of credit history and, quote, to help them get better credit score. So, number one, from a lending perspective, in most cases, the mortgage lender doesn't want you to do that. So a lot of times I have to say, do you see that right there? I need you to call your mom, have you removed off of your mother's account, because that's not your credit card. As an authorized user, you're just kind of borrowing somebody's history.
Piggybacking.
You're piggybacking. Thank
Yep.
you. But there's something also called, what you called it, a joint
user. So
a joint user. Talk to our listeners quickly about that.
Yeah, so a joint user, at the end of the day, joint user versus authorized user, different verbiage,
Sure.
but the goal is the same. Okay, as far as the impact and the increase that it will provide any client is an increase in scores, and how much it's truly based on the payment history. The older the card, typically the more points you'll see added to your score. I personally have done this. I was added to my my father's credit card that was opened in 2003 as a joint user. I happened to have been 12 years old, 13 years old at the time when it was opened, but I wanted to piggyback off that 17 years of history. And just by throwing myself on there as a joint user, now yes,
may have kicked the door open for you to start establishing your own credit.
Yeah, it helped. It started me off on the right track. It gave me a boost. It gave me a some starting ground to start from.
Sure. And in that case, unlike an authorized user, though, if for some reason your dad didn't pay on time anymore,
correct.
you would be responsible
That's correct.
for that payment because you're joint on that card. So anyway, we are out of time I want to make sure that all of our listeners have a chance to get your number, how to get a hold of you. You've given us some great counsel today.
Absolutely. My name again is Cole Duran with National Credit Care. You can contact me via phone, email. My cell is 313-338-4663. 313-4717. One more time, 313-338-4717. And my email is my first name, Cole, C-O-L-E, at nationalcreditcare.com.
Awesome. That's great. Appreciate that. If you need help, please give Cole a call. Just know that National Credit Care is not an affiliate of me or Hometown Lenders. They are separate companies, but I know that they have done a great job at helping many of my clients. I just got a call, honestly, this week. A lady said, my scores are up to 660. I want to get ready to buy a home, and I'm super excited. We got one more dream we're going to help come true here in the near future. So, again, you're listening to Reshair Radio. I'm your show host, Chris Reshair with Hometown Lenders. You can reach me at 704-277-4463. That's 704-277-4463. And you can find me on the web at themortgagegenius.com. That's 3 words, themortgagegenius.com. You need a mortgage loan, you know who to call. And again, as always, you can listen to our shows in its entirety on reshareradio.com. We'll be back next Sunday, ESPN 730, 10 a.m. Listen up. Thanks again, Cole. It's been great to have you. All have a great week. Thanks.